In all the conversations that are going on in your working group as well as in the IIF Steering Committee on Implementation, how does the business consequence of putting in place these measures, how is that being taken into account? In other words, the banks cannot be implementing risk management or adding on to their risk management procedures to the point of being anti-business or being adverse to business in a sense. So what are your members throwing around in the conversation that shows that you want to make this as commercially viable as possible?
We should understand that major changes are being made to the global regulatory framework right now. The rules are changing. And there's a lot of political pressure and momentum to implement many of these very significant changes quickly. Example, we've seen many countries being added to the Basel Committee, which I think, China, India, Australia, and so on, which I think is great. Now suddenly the whole world will be part of making the rules going forward. But in particular, coming back to this pro-cyclicality issue, which everybody agrees we need to dampen the cyclical swings rather than amplify them, there are a number of very specific proposals on the table about how we can do that. For example, just cap the leverage that banks can take at a fixed cap that would apply globally. Now, there's a lot of merit in that suggestion because too much leverage was one of the contributing factors to the crisis. The question is, if we put that cap in place, will that lead to undesirable behavior and consequences? If the banks are capped in their leverage, will that force them to have a higher proportion of riskier loans, for example, to maximize the margin under the cap? What will these various proposals, and there are 3 or 4 of them, do to the risk profile and the stability of individual banks in the system? Banks which have to make a profit inside the rules, how will the businesses respond to all of these new proposed rules? That's what we're working through in this working group. We want to really think through very carefully what the consequences of these new proposals are likely to be. For example, much more capital being held against trading activities. What's that likely to do? Is that going to kill trading? Is that going to have an adverse consequence on corporate clients that want risk management products for hedging? What are the implications on the business side of many of these kinds of proposals? We don't have much time, really a matter of weeks rather than months, to think this through. But we want to make sure that the proposals that do get enacted are the most sensible ones and will have the most sensible and desirable impacts on the actual conduct of business going forward.
Right. Just give us a sense of what will happen to the balance sheet of banks if they take into consideration all the recommendations that your committees are going to be making. What do you see happening in the way banks manage their liquidity, especially in a time of crisis, and their involvement in leveraged market assets, basically?
Let's talk about liquidity first. The failure to understand and manage liquidity was a very major contributor to the crisis. Understandable, because for many years we were all washing in liquidity. Part 1 of the chapters of this IIF report in July of last year laid out a very detailed set of best practices in the measurement and management of liquidity. In fact, the IIF had produced many of those recommendations in March of 2007, but the ink was barely dry on the report when the crisis hit and no one had had a chance to implement them. So there's an industry set of recommendations about liquidity. On the other side of the fence, the Basel Committee has published now a set of very detailed prescriptive requirements that banks will be forced to follow going forward in terms of liquidity, how they measure it, how they manage it, the kinds of buffers they're going to have to hold. So liquidity risk management, or the measurement and management of liquidity risk, was really something that was done poorly before. The bar is being raised and banks will have to comply going forward relatively soon with a very strict set of requirements around liquidity in order to avoid that problem happening again. Now, you've asked actually the right question. all of these kinds of requirements like that, what is going to be the impact?
How is the business of banking going to look like?
It's going to change a lot. Okay, so the correct answer is we don't really know. Okay, what we can say for sure is two things. Banks are very likely, well, banks are going to have to hold more capital against the risk they're taking, given that, especially against trading risks.
Okay.
Right? Given that, some banks will decide not to be in the business. Some banks will decide to significantly scale down the size of their operations. And those that remain in the business will charge more for those kind of products. So there will be some very significant impacts on the business strategy and the economics of these businesses and pricing, which I think are important.